Welcome back, guys. Today we're jumping in to talk about liquidity provision and give you a very brief overview of everything to do with how you can generate cash flow and earn passive income by executing on liquidity provision in decentralized finance. Okay, it's going to be a bit of an overview. I know many of you are already familiar with many of the topics in this video, so this is definitely going to be for people who are a little bit newer to the space and thinking about what it means to provide liquidity and how you're actually generating cash flow. So I think first things first, we need to really understand that as liquidity providers, we are providing a service. Okay, in decentralized finance, across different blockchains, across different decentralized exchanges, you have a whole bunch of different assets that you can swap in and out of, that you can trade, buy, and sell. And when a user is wanting to swap from one asset to another, they have to pay certain fees in order to do that. So what I'm looking at here is Uniswap on my screen, and we've set up a very simple test trade here for swapping some USDC stablecoin into Ethereum on the Base network. Okay, I really want to draw your attention to something at the bottom of the screen here, which is these fees. Okay, you'll notice there's a couple of different fees here that a user must pay in order to actually execute this type of swap on chain in a decentralized manner. The first cost you'll notice is this 0.25% fee, which is essentially the fee tier at 0.25% that this particular transaction is getting routed through. Okay, in this instance, if we're swapping $100 into Ethereum, it's going to equate to about 0.056 ETH at today's prices. But you'll notice that in this case, the user executing the swap is paying that 0.25% fee tier fee of 25 cents on $100 of a trade. The other cost or fee that they have to pay is the network cost. Okay, the gas fee for executing the transaction on the Base network is around 1 cent. So we know Base as a layer 2 scaling solution for Ethereum is much more cost efficient for executing swaps and trades, hence this network cost being extremely low. But this fee, this is really what I'm interested in to explain the premise of what we're doing as liquidity providers, because this 0.25 cents fee, this is what gets paid out to the liquidity providers who are providing liquidity for this specific trading pair on Uniswap on the Base network for USDC to Ethereum. Okay, again, if I jump over very quickly to VFAT, where we can see this pool in real time, you've got this WETH USDC pool here on Uniswap at the 0.05% fee tier. You've got other fee tiers listed here as well. But for example purposes, if I'm a liquidity provider who is putting my capital into this pool and providing liquidity at a concentrated range, we'll touch on concentrated versus full range in a moment, but you can see that I have the ability to earn up to 90% APR here for providing liquidity at just under an 8% concentrated range. Okay, again, very importantly, we're providing a service. We're providing the liquidity for people to be able to get in and out of USDC versus Ethereum, making swaps, making trades, and we're getting paid this fee. This 25 cents fee is what goes directly to the liquidity providers who are providing liquidity, enabling us as liquidity providers to generate this APR or return on investment on the capital we're using and providing into the pools. So I hope that makes sense at a fundamental level. It's not some magic reason as to how we're generating these fees and earning income. The users and people who are swapping and trading and executing those buy and sell orders for USDC and ETH in this example are the ones who are paying that very small fee for the luxury of being able to execute that particular trade, and the liquidity providers who are providing the liquidity are getting paid directly as a result of providing that liquidity and providing that service. Okay, so that is where the fees come from. So again, this differs slightly depending on whether you're doing concentrated liquidity or full range liquidity. Within the Uniswap ecosystem, you'll often hear this referred to as V2 liquidity pools versus V3 liquidity pools. Okay, and V3 liquidity pools is what we're referring to here, where you're providing concentrated liquidity. Again, we are concentrating the liquidity we're providing in this example between a range of $1,694 per Ethereum on the lower end and $1,831 per Ethereum on the upper end. That is a width of range about 7.8%. And so the liquidity that we're deploying into the pool is concentrated at that range, allowing us essentially to lever up the amount of APR and fees that we can generate, because as long as price stays within our range, we're getting paid based on the concentrated range where we're providing liquidity, and we're generating a substantial APR as a result of doing that. Okay, the alternative here would be V2 liquidity pools, which is essentially providing liquidity at a full range. Okay, I'm going to try spot one of the other options here. Maybe I can filter on VFAT to remove the concentrated options. Looks like I cannot for the moment, but you do have the option to provide liquidity at a full range here rather than just providing liquidity at a concentrated range on Uniswap. Again, you can come into the pools area, you can decide to actually create a new position for WETH USDC, for example. And again, you have the ability to select the V3 or V2 position here. So in a V2 position, we're going to be providing liquidity at the full range. So it doesn't matter where the price of Ethereum moves to against the US dollar, we're going to be generating fees and income as a result of providing liquidity at a full range. Of course, you can probably understand the trade-off of providing liquidity at a full range in a V2 pool is the fact that we're going to generate substantially less in fees. Our fee or our liquidity distribution is at a much wider range. It's at a full range, and therefore we're not benefiting from the levered up exposure of providing liquidity in a more concentrated range in order to generate even more fees. So again, the trade-off is that you're not going to generate as much fees. The benefit being you don't have to worry about rebalancing or ever going out of range. Okay, another benefit, of course, of doing liquidity provision and providing this service in the DeFi space is the fact that you are going to generate fees on a 24/7 basis. Again, with V3 pools, as long as you're in range in your pool, you're generating fees on a 24/7 basis. You don't have to think about, getting in and out of trades. You don't have to think about what price you're buying and selling. Yes, you do when you're getting into the pool, but it's not like trading or day trading or swing trading where you're having to execute multiple transactions in a day. Generally speaking, you're going to deploy liquidity at a concentrated level and generate fees 24/7 as long as you're in range. Again, with V2 liquidity at a full range, you really don't have to worry about anything. It is very much set it and forget it. But of course, those fees on a percentage basis, on an APR basis, are going to be much, much lower versus if you deploy into a V3 concentrated pool. Okay, the big benefit here as well with being able to provide liquidity at a concentrated range is the sideways market. Again, if and when we have price moving in a sideways fashion, that is actually most beneficial for us as liquidity providers. If we take a look at the Ethereum chart here, we've been in a bit of a downtrend since the middle of January. And again, this is not unique to Ethereum. Most of the market has been in a downtrend with Bitcoin pulling back since those middle of January highs back down to where we're at today. You could argue we've been going a little bit sideways for the past few weeks. So technically speaking, if you had entered a pool when the price of Ethereum was around $2,000 here, you might be actually still providing liquidity at a healthy range here with price moving sideways. Sideways price action is actually best for liquidity provision because it means price is generally staying within the range that we've defined. If it's moving sideways, we don't have to stress about rebalancing with V3 liquidity, and we're going to continue to accumulate fees from all those swaps and trades as long as price stays within that range and just continues moving sideways. So sideways price action is your friend as a liquidity provider. Of course, if things are moving to the upside, yes, you can continue to rebalance upwards and generate fees and a little bit of price appreciation as that happens. And of course, there is going to be an element of impermanent loss versus if you were just holding the asset spot. But if you're going to generate fees and cash flow as price does that, it's not a bad trade-off, not a bad option if you want to generate that free cash flow. And again, cash flow is king when it comes to liquidity provision. That is the primary reason we're executing on this type of strategy, because we can generate consistent free cash flow, and then it's up to you to create a strategy as to what you're going to do with that cash flow as you're earning it. Again, we're working with a lot of different clients. We've got a number of different strategies. Everyone is unique and everyone is different as to their goals and what they want to achieve with their cash flow. Some people will compound that cash flow back into their existing positions. Many people will take that cash flow, use it to continue to DCA or dollar cost average into more assets for their portfolio. They're using that cash flow to accumulate more Bitcoin, to accumulate Solana, Sui, Ethereum, etc. And sometimes they will take a portion of that cash flow for lifestyle chips as well. So it's really up to you to craft a strategy as to what is unique to your goals and your needs for what you're going to do with that cash flow. But we can help you to do that. Again, check out the UIG, check out the community, check out everything that you're interested in, and we can help you with those goals. Again, finally, the other thing to note is, even though you will experience impermanent loss if price moves to the upside compared to if you were just holding the asset spot, you will also experience less downside if the asset price moves to the downside by providing liquidity. Because remember, what's happening here when we actually provide liquidity, let me remove a couple of these trend lines. If we're providing liquidity to ETH USDC, for example, and assuming we enter the pool with a rough 50-50 split, so price is in the middle of the range here when we enter the pool, you got to remember that 50% of your capital is going to be exposed to Ethereum when you enter the pool, but the other 50% is going to be exposed to USDC. Okay, this means that as price moves up, you're going to get fully converted into USDC by the time you move out of range to the top side. And again, that's going to limit your upside in terms of price appreciation versus if you were just holding Ethereum spot. And on the downside, you're going to get fully converted or 100% converted into Ethereum if price moves out of range to the downside. But again, because you're holding or have half the exposure to USDC when you originally got into the pool, you're actually limiting your downside versus if you were holding Ethereum spot, and you're not going to suffer as much losses as it moves to the downside by the time you get towards the bottom of your range. Okay, I hope that's making sense. I wanted to put together that quick overview of everything to do with V3 liquidity provision. Again, there's a whole world to understand here when it comes to DeFi and liquidity provision and how you can be generating free cash flow by providing liquidity in the DeFi space. We've got tons of different strategies in the UIG. Make sure to check them out. If you have questions, drop them below this video. Make sure to read up on everything to do with DeFi liquidity provision. We've got tons of resources, and we'll catch you in the next video.